Every year, the crypto world talks about institutional adoption. But now we're at the moment of truth, and experts can't agree on whether blockchain is actually ready for Wall Street scale. A16Z's State of Crypto Report 2025 says digital assets are finally going mainstream. The numbers back it up. Stablecoins hit $26 trillion in total volume. That's rivaling Visa and MasterCard. Digital asset treasuries and exchange-traded products now hold roughly 10% of all Bitcoin and Ethereum in existence. And mobile wallets, they are exploding, especially in emerging markets like Argentina, India, and Nigeria. But here's where the debate starts. One camp says the infrastructure still isn't there. They point out that while some blockchains, and especially layer 2 or roll-up networks, are achieving several thousand transactions per second, this still is far below the sustained global scale of major payment networks. For example, Visa cites up to 65,000 transactions per second, and many public chains still operate at effective throughput in the low thousands or less under real-world conditions. Others, like DYDX CEO Charles DeHassy, says speed isn't the bottleneck, reliability is. His take: institutions care less about peak throughput and more about whether blockchains behave predictably under stress and regulatory scrutiny. Basically, can the chain hold when the real world's watching? Then there's cost. For blockchains to truly beat traditional systems, the all-in cost per transaction needs to drop below 25 cents, ideally below a penny. Some layer 2s are already hitting that mark, but it's not universal yet. And that's where things get interesting. Stripe and Robinhood, two of the biggest fintechs on earth, just launched their own blockchains. Critics say that's proof public infrastructure isn't ready, but others see it as validation, evidence that blockchain has matured enough that fintechs want to build with it, not just on it. So, is blockchain finally enterprise ready? Not yet, but it's close. Think about it. Stablecoins are doing Visa-level volumes, institutions are holding 10% of BTC and ETH supply, and fintech giants are quietly building their own chains. The old rails aren't disappearing overnight, but they are being replicated, optimized, and tokenized in real time. The next wave of finance won't look like TradFi or DeFi, it'll be both fused together. The only question left is, when Wall Street's next trillion moves on-chain, will it run on Ethereum, a private L2, or something built in-house? Light me up in the comments.